Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment with Matthew Bartolini, Head of SPDR Spider, America's Research with State Street Global Advisors. Matthew, it's great to see you as always. Welcome back to Trade Talks.
Yeah, it's great to be here.
All right, let's get some of your outlook here as we head into the new year. Where should investors look for growth when it's expected to slow? What sectors of the market would you be looking at?
Yeah, I mean, look, we're going from a boil to a simmer in terms of growth. We're starting to have growth expectations dip below. We're definitely at peaks right now. Next year, we are still be above long-term expectations, but it is slowing. And in our view, this should be favoring more quality, profitable companies. We've already seen that take place, where profitable companies have really started to outpace non-profitable firms as some more worry has come into the marketplace, particularly around how sentiment has started to wane. So we really like quality growth stocks in this type of environment.
How should investors handle the low yield environment for income generation?
Look, I mean, for investors in this market right now, we have 96% of bonds within the Bloomberg Aggregate Bond Index trading below the expected inflation over the next 5 years, meaning a negative real return. It's going to require investors to take on some credit risk. And in our view, this means going into things like senior loans. Senior loans have a elevated yield around 4%. Their duration is only about 0.25 years. And if the Fed does start to raise rates, the coupon, because it can float alongside short-term rates, should likely increase. But also, since they're more senior in the capital structure, it could buffer some of the volatility if we do have a little bit of a tick up in macro risk.
Are there sectors or markets that may benefit more than others in a high inflationary market?
So when we looked at this, we wanted to see areas of the market with less labor intensity, so more capital intensive type of businesses, ones where you wouldn't have so much pressure on margins from an increase in wages. And when we look at sales per employee, this leads us to REITs and natural resource equities. And then when we looked at historical analysis of how REITs and natural resource equities have performed during what we are now defining as sort of quintile 5 level inflation historically, above 3%, REITs and natural resources have outperformed the market, and we expect that to continue to happen based on their lesser labor intensity, but also relationship to other commodities, but also rents in terms of REITs.
So if the growth sector is expected to slow down, is the value factor attractive right now?
Yeah, so when we're looking at this too, when we mention quality, we're also talking a little bit of adding in some value, because quality stocks, much like growth stocks, are stretched relative to the market. What is not stretched are value stocks. When we look at growth relative to value, growth is trading at about 2 standard deviations above value in terms of 5 different valuation metrics. So we like value stocks. So for particularly in the US market, we do like that idea of blending quality and value to find and sort of thread the needle as economic and fundamental sentiment starts to wane a bit.
All right, Matthew, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.